Welcome to this Thursday edition of FreightWaves Now. I'm your host, Anthony Smith, and coming up, Luke Falasca is going to give us a broker update. We also have Mike Baudendistel here with us with the Rail Intermodal update, but first we're going to go to Kevin Hill with the Carrier Update brought to you by PowerFleet. Stay tuned. Bit of a switch up. We have Kevin Hill today with the Carrier Update. Kevin, what's the latest?
The latest is we have what looks like a real floor here on national tender volumes. Okay. Capacity is still really loose right now, so you have to pick your spots. You really have to pick your spots because where we're seeing rises or increases in tender volumes on the OTVI index here in blue, we aren't really seeing a jump in tender rejections here in orange. And you can see that 2.59% on a nationwide basis means that capacity is very loose out there and it's tough. It's a very tough carrier environment. So if we look at the next chart that we have, if we take, so that was the full tender volume index. If we just separate out reefer outbound tender volumes, we see that it's about the same as the composite with dry vans. Very low, 4.27% tender rejection level for the outbound tender rejects. So that's very low for refrigerated. And if we go to the next chart here, we have a tree map of outbound tender volumes. And what we see is Houston has seen a nice jump, 5.6%, LA, Allentown, PA, New York City area, Newark, New Jersey. So we're seeing increases there, a little bit of flatness through this part. But if we go to the next chart here in Sonar, we see the outbound tender reject index for all of these markets. And we see, even though that tender volumes are coming up, tender rejection rates are still, you can see it on the graph right here, they are still just plummeting. So even though tender volumes are coming out, more shipping is happening, it's still very loose in the market.
So capacity is readily available.
Capacity is readily available in all these markets, even though it's a better outbound tender volume or outbound volume picture.
And when we're looking at this, it's like there's uptick. There's been talks of more manufacturing coming online in the future. But we're not quite seeing that capacity come offline. We're seeing some increases in volumes, but it's not quite translating yet.
It's not quite translating, and that's the reason why you have to really pick your markets right now. And as we can see in the next tree map right here is our outbound tender reject index, and it gives you a nice heat map here. And you can see Eau Claire, Wisconsin, Minneapolis, St. Cloud. So up in the upper Midwest, Central, Grand Rapids as well, you're seeing a higher tender reject movement up, right? So more tightness in the market. You have Fayetteville, Des Moines, Virginia, a lot in the upper Midwest, central regions, you're seeing tightness in the market. So if you have any loads going there, plan accordingly.
Right, and definitely a region that wasn't quite hit as hard as other regions when it comes to the coronavirus, right?
That's right. It's basically the states that aren't doing safer at home or are now loosening back up and didn't really have the really strict guidelines of lockdowns.
Excellent, Kevin. Well, a lot of great information here. Thank you so much for this Carrier Update brought to you by PowerFleet. Appreciate the update, and thank you so much for tuning in. That's going to do for this Carrier Update brought to you by PowerFleet. Please stay tuned for the next update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning, everybody. I'm Luke Falasca bringing you another broker update. And we've got some good news today. We're seeing volume levels really start to tick up finally. Still a long way to go until we get back to those normal levels, but it does look like we're starting to get a little bit of momentum behind us. If we go ahead and look here at the chart in blue, you're going to see that's the overall volume level here in the United States. And for the first time, you see we cracked that 9,000 number since dipping below it back in the first week of April. So that's a really good sign. Again, we like to sit around this 10,000 number or even a little bit above it if we can, but so still a long way to go. We're about 10% lower than where we were this time last year, but again, we're headed in the right direction, and that's what matters. Some areas of the country will get there a little bit faster. Others will take a little longer to get there. We're going to look at some of those areas here in a minute, but overall, that's a really good sign. The green line here is the tender rejections. Those are actually still slipping. We saw another downtick, a very slow downtick from yesterday, but nonetheless, still a downtick. We'll see how low they can go. I suspect we'll probably be near the bottom of those tender rejections, just given the fact that they are so suppressed. But as of right now, I wouldn't expect spot market rates to go up in the near term. As of right now, they're still suppressed and looking to continue that way. What we're going to look at here on this next chart is the map of the United States. This is the volume levels, the weekly volume level change here in the United States. So markets in blue are seeing an increase, markets in red are contracting, and the white markets are relatively unchanged. Once again, looking here in blue, we actually have a lot of blue right now. Not a ton of blue in some of those really big markets like LA, Ontario, Atlanta, or Harrisburg, but there's still a lot of blue. Seattle's seeing some good increase, so really up here in the Pacific Northwest, I bet there's a lot of reefer freight coming out of here right now as that season starts to tick up. Down here, a little bit kind of along the coastal region, middle of the country. Chicago's actually seeing a little bit of growth too. They're up over 8% right now on the weekly change, so there's a lot of good areas here. So remember, when you see volume levels like this increase, that has to do with not every market is created equal. When volume levels come up, there's still going to be areas that go down, but there's plenty of areas that go up, and this gives you the ability to capitalize on that. As we look at the next chart here, we're going to dive into the Seattle market. Seattle's a really interesting market right now in the fact that its volume levels, that green line there is the volume levels. So that green line's really starting to tick up, and we're actually seeing volume levels right where we were before the start of all this, of that coronavirus surge. In fact, maybe a little bit above where we were in late February. That's an excellent sign there. And if you look at the blue line there in the bottom right-hand corner of the screen, you'll see that's that tender rejection percentage. Sitting at a little over 2%, while that's nothing to get excited about, it is headed in that right direction. That increase in outbound volume out of Seattle is starting to apply a little bit of upward pressure on capacity, which may start to increase rates. So as you see those tender rejections continue to push up, you're going to see spot market rates rise out of Seattle. If that volume level continues to go up, you might start to see those rejections rise further. We'll have to wait and see, but so far it looks like there's a little bit of pressure out of Seattle. Next chart that we'll go ahead and look at here is Chicago. Chicago is a good market. It's starting to see volume levels rise a little bit. The blue line is the volume levels, but still we are significantly below where we were before the coronavirus surge and plummet happened. So right now we're starting to rise, really only started to rise about 3 days ago. So we're a little bit behind where Seattle is. Seattle's been rising consistently for about a week and a half now, but Chicago's headed in the right direction. Still a long way to go until we capture the rest of this volume levels where we like Chicago to typically sit. Generally speaking, Chicago will sit around the 180 mark. Right now we're around 160, so a little bit of room to go. But if that continues to go up, you'll see tender rejections rise shortly after. I'm Luke, and that'll do it for today's broker update.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the freight tech revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
Welcome to Rail Intermodal Update. I'm here with Mike Baudendistel. Mike, what's the latest?
Well, the Class 1 rails have all finished reporting for the first quarter, and the results were really good pretty much across the board. Yesterday morning, Norfolk Southern reported, and like the rest of the rails, they withdrew their guidance for 2020, but they did retain important piece of guidance for 2021. That's the operating ratio. They're expecting it to be at or below 60%, so that would bring them in line, with the rest of the industry, and the entire Class 1 rail industry would sort of be at that very favorable margin level. Other data point that's come out was the latest week of rail traffic. This is now week 17, and like what was being discussed just a moment ago, starting to see some bottoming there as well. What I have here on this chart is Class 1 rail carloads. So this is just the carload traffic, sort of excluding intermodal units, and it was down 26% year over year. But you at least look, and from the prior week, it's up just a tiny bit from the prior week. So we're sort of thinking, well, now maybe it's going to start to bottom out. I think the worst the rail was talking about for the second quarter was down 25%. That was Union Pacific, but they were already down sort of 22%, and that actually guidance seemed a little bit conservative. On the next chart, we break this down by rail carload segment, and if I did this year over year, it would be entirely red. But if for a little more colored diversity, doing it week over week, and you see that some of these categories are starting to show a little bit of week over week improvement. Motor vehicles is all the way down here. It's usually sort of in the middle of the chart, but it can't go below zero, and that one was finally up 15% after being down sort of 90% few weeks in a row. Some of these others are less cyclical, like grain. The ones that are being hit the hardest are things tied to the energy industry. So you're seeing petroleum is way down, chemicals are down. Some of the construction type products are still sort of hanging in there, and have actually showed a little bit of improvement. Things like sandstone and gravel, metals and those things.
Right. So when we're looking at this, it's just as you mentioned, if we're looking at this on a year-over-year basis, it would just be completely red. So when we're looking at this, we have to take a more granular approach to it, right? We have to look at it more on a week-to-week basis even.
Yeah, exactly. And the year-ago comps are getting more difficult because this is a time of the year where just a lot of things typically move.
Right.
May into June, just a period where people are doing a lot of spending for summer, a lot of big bulky products that require a lot of transportation usage. On the next chart, we take a look at intermodal. Now, today's a pretty big day for intermodal because we had Schneider National report this morning, sort of big orange out of Green Bay, Wisconsin, and then tonight we have Hub Group. Hub Group is one of the conference calls I actually think is worth listening to because they give a lot of good detail there. But what we're seeing on the intermodal side of the business is a little bit of improvement, but still, from Schneider's results this morning, sort of the main takeaway is there's margin contraction on the intermodal side of the business, citing rising purchase transportation costs. Those are costs that they're paying to the railroad, and their revenue per load was down about 4% that they were collecting from the shippers. Now, they did cite a shift to the east, which is a lower revenue per load, as being at least partially responsible for that. We'll see if they have any more detail on pure pricing on their analyst call. But I think those truckload-based intermodal providers are in a little bit of a difficult spot with their margins because the rails keep demanding higher and higher prices for their capacity, and it's difficult to pass those rates on to the shipper given the weak truckload environment, particularly in the east.
Thank you so much. Insightful as always. Thank you so much for that Rail Intermodal update, and thank you so much for tuning in. That's going to do for this segment.